That was a pretty big day. What actually happened at the Fed and what happened to bonds and the dollar is exactly what I talked about yesterday and the past week. I'm not surprised by that. What I am a little bit surprised by is how weak the stock market was, honestly. My framework for today, if you read the newsletter this morning, was for higher yields. The bond bizarro world right now, with inflation sticky and growth still pretty good, when you cut rates and add stimulus in, you gotta reprice the long end of the curve. So that's bearish bonds. The technical breakout there is real as well. The dollar too was already looking like it was strong and firm. None of that surprises me. What I'm most surprised by, and maybe I shouldn't be, because this whole time we've been looking at these trades and stocks going, this is absurd, some of the stuff going on, how hard equities got hit. The yellow light is now on stocks, not just because of today though, but what we've been monitoring, whether it's KG on the advanced decline line, the whole spiel I did yesterday about value trades in one of the worst periods ever. That has been under the surface, breaking down. The risk was that tech would break down too, and that's basically what happened today. If you watch the intraday action, tech was strong early and then faded throughout the day and was a bad sector on the session, so that's not good. So the yellow light's on stocks now. Now, dollar and bonds, as I've been saying for about the past week, I've been itching to change those to reflect the sticky inflation regime, but also the healthy economy regime. So the green light's on the dollar now for a technical breakout, and the red light is on bonds as yields break out and price for bonds breaks down. One thing I'm not changing, once again, crypto fans, I'm your favorite cynic. The green light holds on crypto right now because Bitcoin is a beast and it's got to break down more, I think, for people to really get worried. Let's run through the charts on why. Firstly, for equities, the big thing here has been the dispersion in the market, the breakdown between big tech and everything else. What we got after the election was love for everything, and then that stopped. It became just love for the mags. So when that gets hit today, as the equal weight has already been breaking down, you've got an issue. Doesn't mean it's terrible, but what it means is that if the market is this sensitive to information that was pretty well telegraphed, if I could figure it out over the past week, the yields were likely to go up, the Fed was likely to cut and then say we're going to take it stepwise from here, this was a nothing event. I'm not buying the argument that the Fed is to blame for any of this at all. The evidence so far highly favors Jerome Powell as doing his job right, just based on how strong the economy is today compared to where analysts thought we would be and how many times economists thought the recession would be there. And so what you're getting now is a repricing that suggests equities were way out of line, that perhaps some of the Trump 2.0 bump did create a little bit of a bubble. Because if you get information that was well telegraphed and totally reasonable and ultimately reflects a resilient economy, then you shouldn't be selling off this much. That's telling us this is a major valuation problem. And so you've got now the equal weight below where it was in November. So now this is downtrending since the election. That's why the yellow light's got to be there. It's not red. Big tech is fine still, generally, technically, and who knows, this stuff might bounce right back. But until we then get a new higher high for the S&P 500, the light is yellow. Now, thinking about the macro stuff, this is also where I think you have to zoom out. Very important. I'm going to look at 2-year charts for the 10-year, because you did kind of have a nice little convenient downtrend, but this is arguably breaking it now. You've got the higher high in the yield on the short term that potentially could open up the door for upside. Again, this is something that I think we want to root for as Americans in the economy. The Fed's got to take it piecemeal right now and move slow. We heard the case from Danielle DiMartino that they should be slashing, but nominal rates for jobs are not that bad, even though they've softened up, and growth is still hovering right below 3%. Throw on top of that some sticky inflation. I think Powell's doing exactly what he's got to do. Now, it will become a problem if 6 months or a year from now, or however long from now, the Fed actually has to talk about hiking rates again. Then I'll be blaming Jerome Powell again, and then maybe that'll be the message from the market today. But for now, this is telling us that we probably got into a little bit of a bubble for stocks. The dollar is now finding support and breaking out. So a green light there and a red light on bonds, yellow on stocks. I'll be watching BTC and crypto for any other indications of risk-taking appetite. We still got inflation on Friday. Buckle up.